Hi folks, today I'll be talking about another slide uh, as to where I'll be discussing more in terms of how you improve your odds in quant trading. And as said earlier, everything is mathematical, timing is the key, and how you keep improving your ROI. Those are the type of conversations I'll be having in this presentation. So the good thing about quant trading is everything is mathematical. So there is no emotion, there is no human, like the emotions, which basically plays very much in traditional technique. But here it's a matter of configuring it, optimizing it, and once it's optimized, you let it run. And then gradually, over time, you keep magnifying it. That's the only way you can improve on your ROIs once everything is optimized. So I have discussed a lot in my previous slide as to how you grab the right opportunities, and when you grab the right opportunities, what happens. And I think it is in this particular slide, why passive income. So if you take a look at the previous slide which I was talking about, because this will lead to the conversation going forward, you'll notice that most of the money I'm talking concentrating mainly on passive income, which is more like an intraday type of a strategy where you take the least amount of risk. Of course, in today's world with coronavirus going on, today it's being recording on the 1st of May. We are in the middle of uncertainty with coronavirus, economic uncertainty, and so on and so forth. So I will not concentrate my conversation on anything like a swing trade or intraday or a long-term strategy, but I will concentrate only on how you can generate passive income, keep your risk to overnight risk to almost zero, because you will not be keeping any stocks in the market. You liquidate everything by 345 or 350 and continue growing, doing the same every day. So the impact of it is significant, and I will come to that little later. But having said that, if you keep a concentration on what I'm trying to show here from the previous slide, is see in 9 minutes you could generate 0.59%. In three hours you have generated 0.36%. In 7 minutes you have generated around 0.37% of the investment which you're making. In 15 minutes, you did account around 0.38%. In 8 minutes, you have done around 0.84%. This is very impressive. In 40 minutes, you have done around 0.42%. Now, take this and multiply it with the number of success stories. And if you can do that, you will notice that passive income is probably, I would go for passive income where I don't have to worry about stay. And I'll tell you why. Say, for example, I'll pick up a calculator. So, as an example, if you are, say, targeting for 0.15% a day from your total investment as a first target, and you multiply with say, 252 trading days, you're already making 37% profit. So, your next goal should be that, okay, why not shoot for 0.19% a day and see what type of return I'm making. Here you're looking at around 47%. So again, if you want to be a little bit more aggressive, and I'll tell you all the whole idea is to of this presentation is to explain how you improve your ROI, maintaining your risk. So if you're looking at around say 0.25 as a daily P&L in 252 days, which is roughly a year, you're looking at 63%. So you can keep multiplying this and magnifying this. So this is the beauty of quant trading, which we'll be talking about, because here humans are not there, right? You're expecting a machine to do that, and it'll keep doing as you keep increasing the configurations and also keep feeding him with a lot more stocks. So I'll come to that in a minute. So let's get back to the odds of trading. So having said that, I will probably put it into a presentation mode so that it's easier. But I'll flip through all those four tabs all the time. So in quant trading, everything is timing. So if you look at it, it's all timing based, and grabbing the right opportunity at the right time is key. If you cannot grab the right opportunity at the right time, which we humans cannot, of course, we'll end up with losses, we'll end up with all sorts of stuff. But if you can master the configuration, the sweet spot, let's call it as a sweet spot, and execute that sweet spot whenever it comes, whichever day it comes, whenever it comes, how many times it comes in a day, doesn't matter. You keep executing it. There is always profitability, or the odds of profits will be very high. And you have seen that, which I have demonstrated in my previous slide, that some of the trades could settle in even 8 minutes time. So having said that, I would expect everybody to go through the first slide, which is here. It is also on the website. If you go to my website, which is wgsinvestmentclub.com, and under the contact, you will see the first slide in the form of the YouTube. The second one, which I'm doing now, would also be somewhere here. So I would expect and I would appreciate viewers who are getting in touch with me to go through those two slides so that our conversation can go further. Uh, because I will try and explain exactly what is quant trading, how you can improve your returns through quant trading, and how you can minimize your risk, and what are the techniques in order to do that. So if you can do that, passive income is not a big deal at all for you. Every day is just logging into the machine and the machine runs on its own. You can also get in touch with me. There is a WhatsApp here. You can also get in touch with me from wherever you are, and wherever I am. Leave a message or call me or whatever. We will try and communicate if you have questions and anything of that nature. Or you could also get in touch with me from the contact form. You can put in your name, phone number, and email with your message, and get in touch with me. It is important that once you understand these two slides, then we can take this discussion further. Otherwise, it will be a situation where you will not know what to do and what to expect. And I too will have to go through a long explanation of what is quant trading and how you can make very decent returns from quant trading. So when you go there, when you come here, you can choose any of the dates which is available, and you can select that time depending on my availability, and you just confirm it with your name and email address. And if you want to talk about, write to me something where you want me to focus that on that particular day, when you want to discuss anything, you can feel free to do that too. So communication will be always open with me, and I will give my best efforts to see if I can handle your questions. Of course, sometimes slots are empty, sometimes slots are full. Here, slots are empty. I also try to accommodate during the weekends, but it's not a promise that I can do every weekend. But right now, it seems like I have time on a weekend even to attend some of your questions. So having said that, let me go back to the point which I was trying to make is everything, these two YouTubes which you'll be seeing will be in this section of contact. So now let me go back again to the odds. So what is happening here is, first of all, the most important thing, which when we get into quant trading, you have to decide with your mindset, because what you're doing here is you're telling the machine what to do. And if you yourself are not sure about what to do, then you cannot expect the machine to run correctly for you. So there are three different types of mindsets which I'm trying to plot. One of it could be a conservative mindset, a moderate mindset, or an aggressive mindset. So, and I'll show you that how these mindsets would determine the chances of your risk and gains, how you play with your odds with these three different types of mindsets. So we cannot blame the machine. When we make a mistake, machine will do exactly what you are asking him to do. But we cannot go and tell the machine that why did I lose money? No, because you have done something wrong. You have plotted something wrong, and the machine has done exactly what you have asked the machine to do. So I would personally blame myself before I blame the machine, because machine will exactly do what you're asking him to do. But if I cannot find the mistakes I have made, there's no way I can improve on the ROI. So ROI is a process of improvement, as I have mentioning here. Of course, with my help, I will try to um, see that you don't have to go through all the hurdles of all the 14, 15 years of research which I have done. I will give you exactly, try and give you exactly what would be appropriate for you once I understand your mindset, whether you're a conservative investor or a moderate investor or an aggressive investor, because this is very important. This is every individual's, this is where the emotion plays. And if you can control your emotion with these three parameters which we are talking about, you have you probably won half of the battle. So now in my previous slide, I have explained two things, and I will take you there again for a second. There are two very important components. One of it is the market, which I spoke about in my previous slide. And the second one is the individual stock. So if you find a sweet spot where the market is in your favor, the individual stock is in also in your favor, then in within 20 minutes you can see you are making around 1.22% of whatever you invest. You can, here we are talking about $6,000. You could be investing $15,000 also. So making within 20 minutes 1.22%, and that also with again with multiple stocks. If you have a very decent portfolio size, you can imagine the exponential impact of your returns. So as I said earlier, that you could target, if you're not greedy, you can target your daily returns to a certain percentage. The algorithm will, you can probably say that, okay, you know what, if I can make only 0.26%, I'm done for the day. Then you just multiply with 252 as an example, ballpark, on a ballpark, you'll be around 65%. But if you're targeting for like point, say, 30%, which is a very hit, and I'll tell you how you get to this type of target, uh, times 252, you're looking at around 75% of the return. So the return is completely in your control. Return is always will go with the risk. So I will talk about all this as to how you play with the odds and how you improve it in this particular presentation. It might be lengthy, boring, but it's worth listening, because once you get this sweet spot and you run it for your entire lifetime, every day it will be the same story. Every day. So to understand this, it is very important. So this way you can set up your target. Or you can also say that, okay, you know what, I don't want to have a target. I can close all the positions at 345 no matter what and start the next day again. But having said this, as I said in this particular case as a target, you could meet, say for example, I'm just giving an example that you're putting in say 0.28% as your target for that day. If the market is bull or bear, and depending on the direction you're going, you could meet your target by 1 o'clock or maybe by 12:30. So you're done. You're done for the day. So this is good for day traders. Day traders, especially who want to trade without a stress, this is a very good feature. But your goals are your goals. Nobody else can dictate what your goals should be, depending on what type of an investor you are. So if you are a conservative investor, I would say that okay, if you know what, if you're looking for around 0.18%, you're good. You're making 45% return. So what you have to do is you don't change anything in the parameters, just keep pumping new investment into it or pumping money into it, or use leverage, and I will come to that a little later. But now let's concentrate a little bit here, because this is also a very important point, that how you set up your expectation level based on your odds. So as I said in my previous slide, I was talking about market and individual stock. So here I'll focus a while for market. If you notice here, I'm telling the algorithm that you know what, get into a trade when S&P is over 0.25%, with the green means go long from your list, and S&P, when S&P is minus 0.25%, go south with the list which are talking about shorts from your list. And you are telling it, telling the algorithm further that okay, you know what, you keep a look into the last 5-minute bars anytime during the day when it is taking a higher high. Because if it takes a, say the second one is high, the third one is assuming low, then you disqualify the market. Why you are doing that? Because you are trying to make sure that you are entering into the market when the market is on the rise. I'm talking about here when you're going bull, but and with long positions. But when you're going bear with shorting, it'll just be the reverse. It'll take a lower low. So you can say that, okay, I want to look into the last 5-minute bar where last 5 minutes the market is in the rise, because sometimes I have explained on the previous slide that you may start an S&P at around 10 o'clock with 0.65%, but as the day progresses, it starts here. As the day progresses, the S&P keeps going down to 0.3%. So then this condition does not satisfy. So the point is, although the market is green, but you have not got the sweet spot. And if you don't get the sweet spot, you will get into a wrong trade where you will not be able to milk out profits within 30 minutes, 7 minutes, 1 hour, or 2 hour. So if that's what you're looking at, it is very important, very, very important that you enter into a sweet spot. So that's one aspect of it, that you're looking, telling the market has to go higher high. Now, if you start looking into the difference of the four, which I have plotted here, here you're telling S&P to be 0.25%. If it is over 0.25%, I will go for long positions or short positions. Uh, if it is in between, I will wait. I will not do anything. But if you compare this with the first one here, where you are saying that the S&P is over 2% and S&P, I'll go long, and if the S&P is below minus 2%, I'll go for short. So now if you notice the extreme left and the extreme right here, What is the difference? Here, you're telling the S&P that it is over 0.25%, I will jump into trades. Here, you're telling the S&P that if it is over 2%, I'll get into trade. Means you are more careful. So if you take this as a configuration, you'll be taking a lesser risk as compared to this particular configuration where you are taking a much higher risk. But again, this is the configuration you are telling the algorithm that, okay, don't get into trades unless these parameters fulfill. But what is the downside of it? Of course, you're ensuring that all your trades, if you're taking the least risk, all your trades will be successful, no doubt. But the downside here is you might be trading out, say, if you have 20 stocks in your list on the long side, you may be trading on one or two of those with the least risk. But here, in this case, with the higher risk, you might be trading on 6 or 7 stocks out of the 20 stocks. But again, your odds are against you. Here, you might be landing up with, say, out of 7 stocks, you may make money out on 4 of them and you might lose money on 3. But in this case, out of 7 stocks, you might be making money on 6 of them. But what is happening is this situation, this scenario, the S&P over 0.25% and S&P over 0.2%, I'm talking only on the long side, does not come every day. Maybe this will come out of 20 days, you might get into this situation maybe uh, 10 days over 25.25% or maybe 14 days. But you will get into this situation when S&P is over 2% out of 20 days, maybe on 3 days or 4 days, considering the current market. Now, if the market improves, economy improves, everything is beautiful, then 0.2% in a month, you could probably get this type of an occurrence happening maybe 7 days in a month. And if the market continues going up, economy is going up, everything is beautiful, you might get this scenario maybe 14 days in a month, but that will hardly happen. So the same on the downside. Like now with the coronavirus scenario, when I'm recording, we had a very bad market for weeks, I would say. And during that time, you must have noticed that the S&P was below minus 2% out of 7 days, maybe 3 days. So that's the opportunity you are waiting for. That's exactly what you'll be looking at when you're waiting for the right opportunity with the right timing. Now, if you want to temper it, say you want to say that, okay, I want to get into trade when the market is, say you have set it up at S&P over 2%. Now, all of a sudden you realize that 3 days you did not trade, and I told you why. You want to reduce this from 2% to say 1%. You have to always remember you're playing with the odds. That means in this case, say out of 50 trades, if you have made a win on 45 of those, here in this case, when you're reducing the odd, which is you're telling the S&P to be less than 1%, you might be landing up in a situation out of 50 trades, you're making profits out of 35 and you're losing on 15. So don't blame anybody. It is your mind which you have changed, maybe because of people are greedy, people have different types of mindset which I cannot talk about here because I have no idea. But if I am a conservative investor, I will set it up at 2% and that's it. I will not even come back and look into my algorithm. The days when the market is over 2%, I mean the S&P is over 2%, I know I'll be trading today. But if it is not, it's not. So it could happen that in a particular month, you are getting S&P over 2% in 5 days. And I know that, okay, I'll be trading only 5 days. But when I trade, I make profit. I make sure that 80 to 90% of my profits are happening within a very short time, and I'm coming out of the trade without any risk. So this configuration which I'm trying to get to is all based on how you control your mindset and tell yourself that, okay, if I'm reducing from 1% to 0.25%, what are the odds against me? So there is there are a lot of people who ask me the question, how much can I make? I cannot answer that question because this is what which will drive your return. So it's very important that when you configure or you ask me to configure your algorithm, this point which I'm making here is at the back of your mind. If you're compromising on something from 2% to 1%, you must also know the counter effect of it. Like in physics, we have learned, right? Every action has an equal and opposite reaction. So that's exactly what I'm trying to refer to here. Any action you take will always have an equal and opposite reaction. So if you don't know what are your odds, then don't play with it. But once you know what are your odds and you're willing to take a chance, sure, go ahead. But without understanding the implication of your odds, you should not play with it. You can ask me, I will help you, I will give you the right direction, and then you can make a choice of yourself, knowing what are your odds against you. So now again, if you take a look at here, from a 5-minute bar, everything is same. You're now looking at a 10-minute bar. So what you're doing is you're telling the algorithm that, okay, I don't want to look into 5-minute bar, because if you're pulling on every 60 seconds, it's going to look into that 5-minute bar to make sure that the market is higher high. Now, if you want to fine tune it, you can also make it to a 10-minute bar for the last two bars where you're looking into a higher high. Of course, this will improve or it will deteriorate your ROI percentage, would depend on how much of a research you do. But I'm just trying to let you know that any changes you make will always have an equal or an opposite reaction. Remember, this is not traditional investment. We are not talking about traditional investment. We are not talking about human mindset here. We are exclusively talking about quantitative models where you're basically defining the algorithm what you want knowingly and understanding the consequences of it. So once you understand the consequence, it is very easy for you to relate. So out of the two, if you're looking at a 5-minute bar versus a 10-minute bar, here I would say that you're a little bit more conservative as compared to the one which is in a 10-minute bar. So especially if the market is very volatile, very, very volatile, things are changing. Wall Street news are, White House and Wall Street news is blasting all around. Markets are uncertain. Every minute things are changing. Then in that case, maybe a 5-minute bar would be a good bet for you to check on the market. But if the markets are stable, whether it is going north or south, doesn't matter. If it is stable, in that case, maybe 10-minute bar would be also a good idea. So it again depends on the volatility of the market. So if your markets are very volatile, my recommendation would be to keep at 5-minute uh, 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 bar to understand the last market condition, or you could move to even 10-minute bar with if the market is less volatile. So I'm trying to explain the difference as to wonder what circumstances you should instruct me or go and change a configuration if you are allowed to do so in the order engine. I don't know what changes you'll make, but you understand what you're asking me to do or anybody in my farm to help you out with your changes in the configuration. because every change you make here is going to have an impact. If the market is extremely volatile, then 10 minutes is pretty risky. You should keep it to 5 minutes or maybe even 2 minutes if it is extremely volatile. If it is not, then you can get to 10-minute scenario. Now let's talk about a scenario here which I am trying to explain, which I did. If it is over 2%, you're taking a lesser risk. If it is over 1%, you're taking slightly higher risk. And if it is over 0.5% as you're configuring, you're taking a little bit higher, more risk. But there could be also scenarios where you are saying that if the S&P is greater than zero, ignore the market direction. That means you could set it up in such a way that I don't want to look into the market at all. I'm a guy with research, and I know that my stocks will go up or down based on my research, irrespective of the market. Then you can say that, okay, I want to ignore the market completely. So again, those are for people who are at a very advanced level, who understands what they're doing, who understands their research and has confidence in their research that, okay, these are the stocks which will take a long spike today heading north. In that case, you ignore the market completely. The algorithm will not even look into the market at all. It will pick up the stocks from the list you have and start executing it if if you have those lists based on your research. So the point in this slide, which is very important, and I'm trying to rephrase it again, that every move you make in quantitative trading has equal and opposite reaction. If you do not understand the consequence of the changes you're going to make, please don't do so. You can ask me, I will help you out, but of course I will not be able to tell you the output of all the permutation combinations you have, but I can give you a go ahead or don't go ahead type of advice. Of course, the ultimate decision will be yours, but what will be the effect? So every day the markets are changing. Every day, today we are into coronavirus, tomorrow we might be into geopolitical issues with China and all sorts of stuff. So there is no end to it. So conditions will keep changing. We have to always keep in mind that the market conditions will always change. So would be the configurations if need be. But in my case, I have configurations for certain type of investments which I do. I don't even touch it for years. I don't even get into that configuration model at all. I'm happy with what I'm doing. The returns are consistent because once your configurations are preset and you're happy, every day the scenario will be the same. So the consistency with quantitative trading is a very important element which traditional techniques don't have. So having said that, when you make any change in the request that, okay, I want to reduce the S&P from 2% to say greater than 1%, you know that what are your limitations, what are the risks you will be taking, and so forth. What are your odds and what are the chances you are taking? Please don't let me know or come back to me saying that how come I'm losing money today. Because of the changes you have made, you have taken a higher risk. That means you're willing to take a risk, and the market is from 2% to 1%, and you're willing to take a few trades from on this scenario, means you're exposing yourself with slight risk. It's the same theory, right? If you're driving at 60 miles on a highway versus 95 miles on the same highway, you're taking much higher risk of an accident. Of course, the trade-off could be that you are reaching a destination within a much shorter time, but you are also risking yourself. So in quant trading, everything has an impact, equal or opposite reaction, the same Newton's theory which we are talking about, although it doesn't sound realistic, but actually it is true. In my last 15 years, this is what I have learned, and this is what I'm trying to tell you, that out of my research, which is going to be a shortcut for you, of course, that do not make any changes unless you really understand the implication. So let's go to the next slide. Now here what we are talking about is what makes a difference if one takes three execution strategies, which I just told you before: conservative, moderate, or an aggressive investor mindset. Say for example, you have an individual stock, and here we are talking about MA, moving average of 2 and 10. So people who understand stock market, this is one of the lagging indicators that, okay, you know what, the moving average for past 2 days or past two bars is what I'll be looking at. Your bar, this is, you can treat this as a bar, number of bars. So you might be looking into last two bars of 10 minutes, or you might be looking into last two bars of 10 days. So the bar could be a day. So it means you're looking into last 2 days, or you're looking into 10 minutes or 5 minutes or 15 minutes. So now this is the ratio which you'll be looking into as a moving average 2 of last 10 minutes versus the moving average of the last 10 bars. So these two difference, if you're saying that it's over 1%, I'll take a long position. So now what you're trying to do here is, again, very important. You are measuring the lagging indicators, because this is a price movement momentum, right, which you are looking at very closely. You're trying to tell the algorithm that look into the last two bars of 10 minutes, or you could look into the last two bars of 20 minutes, or you could look into last two bars of daily bar versus the last two bars of 10 of that daily bar or 5-minute bar, whatever that bar is. And if their differential is over 1%, then you're telling him to take a long position. So in other words, if you want to be conservative here, you can say that, okay, I will take that bar and I will increase the differential to 1.5%. So that means when the algorithm is looking into that individual stock, exact after it qualifies the market, if you want the market to get qualified first, as I said, you can make a choice that you don't want to look into the market at all. It's up to you. But if you want the market to get qualified first, as to what I explained, and you come here, you are telling the algorithm that I want to look into these two differentials if it is over 1.5%. So that means you are moving from, say, as an example, from an aggressive guy, as an example, to a moderate person. Now, if you say that, okay, I want to trade on those only if it is over 2%, that means from moderate, you're getting into more conservative mode. That means you're asking the algorithm that if the stock is not heading north and you are not getting a confirmation that it is not heading north, you don't want to trade. So these are the combinations which will get you to sweet spot. So now when you get into this type of sweet spot, as I said, and as I have explained earlier in my previous slides, that this is not a difficult scenario at all. Because once you confirm that, okay, this is your sweet spot, this is where you want to be, you will notice that in real trades, you're probably in 20 minutes, you're making a very decent percentage. So if you go back to the previous slide, you'll notice in different intervals of time, you're making different percentage of profits. So this is because of the sweet spot. The sweet spot is so important. So I'll go back to the one which I was explaining. So having said that, if you compromise with the percentage here, means you are taking a little bit more of a risk. If you are more rigid, say for example, I would like to put it at 2%, and I say that I don't want to care. I don't care how many trades I do in that particular day. If I really want to do a lot of trades, now I have got 50 trades, maybe I should look into 300 trades. My chances will be much more from 300 trades than to compromise here. So that's the way I would think. I would look at it. But I'm not going to compromise, say, 2% for a long position. If I have it at 2%, I'll rather keep it at 2%. But I will rather go for a larger list of stocks. Maybe if I'm looking at 50 stocks and I'm not able to qualify anything because this is so rigid and the algorithm is rejecting all these stocks every 60 seconds from those 50 list of 50 stocks, maybe I will increase that to probably 250 stocks. That way what happens is I'm increasing my opportunity. I'm controlling the same parameter. That means I know that this parameter will give me a success, but I'm instead of looking at 50 list of 50 stocks, I'll probably look at probably 300 stocks every 60 seconds. So do not, that's what I'm trying to say, that do not temper with this type of thing that, oh, you know what, I let me change it to say 5-minute bar or 15-minute bar. Once you know that you have identified a sweet spot, it's giving you a result, and you want to change it without testing it out, don't do that. That is my personal advice because I myself don't do anything. If from my last 15 years of research, when I land up with a certain sweet spot, I stay with it. I rather increase the number of list of stocks. From 50 I can go to 250, or from 250 I can go to even 500 stocks, and I'll come to that a little later, but I will not temper anything here because this is under these conditions I know that I can make a sweet spot where my trade is successful within 15 minutes or 2 hours or whatever it is. So now the same goes here. Now if you reduce, or let me bring the pointer again, if you reduce your, say as I explained, your moving average of 2, you reduce it or change it. Let's not call it reduce. You change it to say moving average 3. That means you're looking into last 3 bars. You're looking into the moving average of 3 with a 10-minute bar. So that means you are now gauging the differential between 3 bars versus 15 bars, and that's where you are gauging. So if you take a difference of the two, I mean look into these two things, here you are getting a less rigid because you're looking into moving average 3 over 15 and moving average 2 over 10. Definitely this is a little bit more conservative as compared to this one. So when you make these changes, and now here you see that you are also telling the algorithm that, okay, I want to have a differentials of 0.75%. So on one hand, you have reduced, you're less rigid. On the other hand, you have reduced the tolerance percentage, means here in this scenario, you'll be taking more risk as compared to this scenario. So if my point to you is do not temper. If you have already found a sweet spot here and you're getting 80% of your trades are successful or even 90% of your trades are successful, do not temper it. That's exactly what I'm trying to say. Because if you temper, there's a chance that you might, without testing, you might lose money. You can do this. You can do it on an, say you're running real. You have a real platform, I mean real money account, you're running this, you're very happy. You want to make some change from 2 to 3 and 10 to 15, and you want to observe how is this performance. Of course, do it on a simulation. Don't do it on real without understanding the implication. Again, that Newton's third law applies. Every action has got equal and opposite reaction, because this change, where it will take you when it comes to ROI, volatility of the market, the conditions of the market changing, which is not in your control, you have no idea where this might take you. It could be a better ROI or it could be poorer ROI compared to this. So unless you test it out on a simulated platform for a few days, do not take that change into the live environment. So that's the point I'm trying to make. Here, as I said, everything, everything you do is precision based because there are no humans playing any role. So when you do anything of that nature, make sure you test it out. It gives you a good result. You're happy, and then change that configuration if need be. Otherwise, don't temper. That's my professional advice for the last 15 years of research which I'm going through. Now we'll come to another important point is, as I just mentioned, how can one play with the odds to generate returns and gradually increase it? So your goal, of course, is to increase your ROI, right? As I told you, as I was explaining it to you on a calculator, that you can target from 0.17% per day to 0.23% a day. So if you take that as a target, what are the things you need to do in order to achieve that target is what the goal should be. So now let's look at one thing which I told you. Don't tamper with the market once you have already decided what is the sweet spot there. Don't tamper with your individual stocks once you have decided the sweet spot. The only options you have is you can increase your number of count. Say you are playing around with 100 stocks. Now you can increase it to say 500 stocks or 300 stocks. That means you're in playing around with more of the opportunities which will come because the algorithm will keep qualifying. Say market is for everybody, but the individual stocks may not be the same for your entire list. Apple could do better than Google when it comes to those type of a parameter. So you don't want to trade on Google unless you are very sure. So what you'll do is you'll look into Apple first. And then when Google is not doing well and it's rejecting, you might be looking into Bank of America, Tesla, or so and so forth. What are you doing? You're actually looking into more stocks. Your count list, increasing your list from say 100 stocks to maybe 400 stocks. I'm just giving an example. Secondly, as I have said, that some of you may think that, okay, you know what, my fund manager hardly goes into the account, but at least in this quantitative trading, I can ask the algorithm to look into my account every 30 minutes. Fantastic, you do that. But if you are looking for improvement in your return, then from 30 minutes, you might be looking into 15 minutes pulling interval. In my case, I look at every 1 second because the volatility of the market is so high that you don't want to wait. You just, as the opportunity comes, as you hit the sweet spot, you get into it. You trade it as the milking AI exits out with on a sweet spot, it milks out profit for you. So if you keep your pooling interval at 2 hours, I'm just giving an example that you put it at 10 o'clock and the next pooling interval is probably happening at 12 o'clock. So what is happening is maybe in between 10:30 to 11, you could have and you have a list of say 250 stocks. So you could have had opportunities from 250 stocks from 10:30 to 11:30, but you have not used it because your pulling interval is at every 2 hours. So the algorithm will run for you at say 10 o'clock as an example, and the next time it will run for you at 12 o'clock. But in between 10 to 12, a lot of good things can happen. So you are losing out on opportunity. So the two things which you need to do in order to improve your return, and it's not a hard work for you, it is just increasing the count of stocks. If you're looking at probably a list of 100 stocks, you might want to go into a list of 300 stocks. If you're looking into a pulled interval of 15 minutes, you might want to look into a pulled interval of 3 minutes. If you are if you want to further improve it from 3 minutes, you can probably get into 1 minute. But with this, as I just explained, will improve your opportunity. And when your opportunities are improving, I have already explained in the previous slide that when trades settle and settles in a large count, you can imagine the exponential impact of your return, keeping all your parameters at a very safe level. Means you're not tampering with the market. You're saying that, okay, if the market is over 2%, I will trade, and the bars are going higher high. On the individual side, you are saying that, okay, if the differential between, as an example, 2 and 10 is over 1.5% on the tolerance, then only I will qualify that stock with the market together. That means these are scenarios that where you know that 90% of the time you'll have a successful trade, 90 to 99% of the time. But you need a large number of stocks to look for opportunities, or you also reduce your number of pulling interval from say 15 minutes to 1 second. 1 minute. So if one faces a loss, how do you improve it? Of course, as I said, that when you're looking into market, you make your market more rigid. Say for example, you are looking into that, okay, I will get into trades when the market is S&P is 1%, and you landed up with a loss, and I'll come to that in a minute. So what you do is, you, instead of having it at 1%, you increase the market conditions to be over 2%. That means you're telling the algorithm that if the market is not over 2%, I won't trade. So that means you're making the market rigid. So that will improve, of course. Your odds will reduce for any loss. Is improving on the individual stock. So as I say that you could have gone into moving average 3 to 15 with 1.5% tolerance. Now you can reduce or you can make it more rigid to 2 and 10 with 2% tolerance. So that means you are making your odds in your favor with more gains to come. But of course, you're willing to compromise and get a lot more stock count and pulling intervals and all. Of course, in the when it comes to machine, these two things will increase the capacity of the RAM. Everybody, I don't know whether all of you, did I tell before in any of my presentation, everybody gets a virtual machine from Amazon, right? So if you're saying that, okay, I want to increase it from 100 to say 250, and my pulling interval from say 2 minutes to 1 minute, you're asking the machine to work harder for you. So that's a different area of conversation where you're basically asking the virtual machine to be much more powerful. But from your end, you're not doing anything. So that way what happens is, when your markets, you want to make your market rigid, improve on your losses if you face any. Yes, you make the market more rigid, you make your individual stocks more rigid. But on the other hand, if you are making profit and you want to improve the situation, of course you can keep the market same, individual stock same, but as I just said that on the stock list you can increase your count. On the pulling interval you can reduce it to 60 seconds. Now you have got into a situation where you're improving your profit. So having said that, you can go both directions. If you face a loss, you can be more conservative and keep being conservative till you get into a point where you're making profit, or if you're getting a lot of profit, you can improve your or magnify, is what I was trying to talk about with the stocks. So having said that, so success to fail ratios, say you have got 20 stocks, say only 5 of it qualifies to trade based on the market conditions here. So let's say on the first cut you're saying that, okay, if it goes north, assuming it's a long position, if it goes north by half a percent, I will take that. Or if it goes south by minus half a percent, I will absorb that loss. And you notice that by doing that, you're saying that, okay, you are seeing out of five, three are winning, two are losing. So, of course, this is a profitable scenario that you are, because two win will knock out two losses. So you're making money out of one. But now there comes a question that, okay, how do I improve this? So keeping everything same, I'm not tempering with market and individual, how do I improve it? So there are only a few ways to do that. One is to increase your investment per stock. Say you're trading at $5,000. Now you can trade at $10,000. Of course, you'll need more portfolio size, and you also increase your stock counts. So you increase the stock count, which we are talking about. And by doing that, you might notice that your profitability out of five could be four and one loss, because you are expanding the opportunity level here. So you are in putting some money, you're increasing the number of stock count from say 100 stocks. Now you're scanning every 60 seconds 350 stocks. So of course your opportunity level is much high. You're looking into a much higher scenarios of making chances to make money. So having said that, now if I'm looking concentrating only on intraday and I want to continue growing, so this is exactly what I say, that intraday, I'm not going to talk about what do you call swing or long trades, because their parameters could be different and this is not within the scope of this discussion. But if anybody has any question and they are interested on swing trades, on long-term trade investment strategy, feel free to ask me. But my focus here is more on intraday, where I'm trying to trade with the least amount of risk, considering what we are going through now with the uncertainty of the economic conditions. So let's talk only on intraday. So if you're talking about say 50 counts as your list, out of which you are 30 you win, 20 you lose, and you keep your stop loss at say 0.5%, and no investment zone is say 0.5% to plus 5%, and you are investing on $5,000. Now see the changes which is happening. Of course, this is here you're taking a lot more risk, because your investment zone is only minus 5.5 to plus 0.5. But if you come here, your investment zone is much higher. That means you are increasing the market conditions and certainty from the market, so that the odds get in favor of you, and you move from 50 trades which you're doing to 45 wins and maybe 5 losses. So now if you do this and if you accomplish this, say as an example, and you're happy, what do? All you have to do is, probably one scenario is, you increase your investment per stock from 5,000 to 10,000. Of course, you'll need more money, but that will boost up your returns on investment significantly, because what you have done so far is you have optimized it. You are at this level, 30-20, 40-10 to win-loss ratio, now into 45 to 5. And why? Because you are changing the market conditions, changing the parameters of individual stocks and all those things which I spoke about, and say you have achieved this. This is a fantastic achievement. So you want to lock yourself here. So the point I'm trying to say is, don't make any more changes here. Stay here. Don't change. You can start then investing more money with say $1,000. $10,000 from 5,000. You can start looking into use of leverage. Leverage is a beautiful thing which every brokers give, and especially interactive brokers. Of course, this is intraday, so that you're not holding any money overnight, so it doesn't make any difference. You don't pay any interest on the margin loans which you take because you're not holding anything on intraday. You're closing all the positions at 345 or 350 anyway. So interest part for margin loan is out of the scope because you're doing intraday. But if you would have done swing trade or long-term trades, then of course margin interest margin becomes a point of conversation. But in this topic, I don't think I need to touch that, because although you are using leverage, but you are liquidating all your positions by over within the day. So any broker, I'm doing with Interactive Brokers. We are a vendor of Interactive Brokers. Of course, we know their rules that they will not charge you any margin loan if the money is not overnight invested in the market. So what you do is you use that leverage. Say you had 500,000 as your investment size, because you first of all you use your own money, and then Interactive Broker will give you roughly 4 times of that 500,000, which is roughly 2 million. But maybe you can use 25%, 55%, 50%, and then 75%, because no matter what, at the end of the day, you are squaring off all the positions and everything is squared off. So you can increase your profitability. So as I said, that there is no limit. There's no limit in quant trading as to how gradually you can improve your things, improve your returns. So having said that, I think this was the fourth slide, but one more important thing which I would like to talk about is when you make your list. So as I say that, okay, if you might have a question that, okay, how can I make my list from say 50 to 200? So this is a site. There are a lot of screening sites anyway. I don't have to talk about where you can find these stocks. You can find it in Finviz, you can find it in Yahoo Finance and all over. But the point I'm trying to make is that as you come into a point that you now need to have more of your stocks to increase your ROI, you can do this. You can screen it up, but if you notice here there are probably 18 pages, and if you take the calculator, say 20 stocks times 18, right, they're 20 per page. I'm just giving an example. So you're talking about 20 times 18, which is you already have a list of 360 stocks. So if you're at 100 stocks, you can now make use of, you export this into Excel and plot it in the type of a parameters which is looking, which the algorithm is expecting, that you will find it on the website anyway, and I will show it to you. If you come to our website and you look into say home, I'm trying to get to what type of parameter or what type of a list you need to maintain. You can go to business or individual, doesn't matter. So once you come to business, you can choose say intraday, which is the third one. It'll give you all the features. So under the features, there is something called list, my list or something, if I can recollect that. Yeah, list. It could be a static list or a research-based list. So these are the type of parameters you need: the trading day, the symbol, which is the stock, the trade, whether it is you want to go on the buy in the long directions or short for shorting, their current price, the target price, which could be a formula stuff, and a sort order. So I would encourage everybody to listen to this YouTube so that you understand how you prepare your list. Now, assuming that you have probably got, say, as I just spoke, that you had a list of say 100 stocks, or now you want to say increase it. So for example, if I want to, if I take Mega. So you see, when I'm looking into Mega, which is a phenomenally high market capital stocks like Amazon, Google, and all those stuff, provided you can afford to buy it at this price, yes, Mega would be a very good option. But now Mega is only giving you probably 7 of those. So 7 is not enough. Now say for example, you want to go to large, and now you are seeing that you have got 18 of those with a different price. So now if you want and you say that I want to control my prices, the price range, so you can probably have, say, I'm just giving examples, but you can say that, okay, I want to go under $20. Again, it's not too many. So you keep adjusting it. Maybe over 4. So now you have got quite a large number of stocks. Then you can say that, okay, I want to have something which has got very high volume, and I want to select that. So now you have got another count of stocks. So you can keep filtering whichever way you want to. Okay, I don't think I will play any role in telling you how you could make your list. But all what is needed are these 6 parameters. Date, you can put a formula here, which could be always the current date, the system date. You could have the name of the ticker. You could have the trade, which could be buy or short. Some of them which whom I deal with, sometimes they have 50 stocks on the list, and out of the 50 stocks, they keep 25 long and 25 short, but they keep the same stock. And the logic is, if Facebook on a bull day is going north, on a bear day, the same Facebook can go south. So you don't want to compromise on the quality of stock with the volume. You rather keep it to there and trade with the wind. Like on a bear market, even Facebook will go down. On a bull market, Facebook will come up. The same with Tesla or Google or anything, provided you can afford it. So I will not touch this one because this is completely your choice as to how you want to maintain it, but you have hundreds of options to do that. The second important thing which I will talk about, and that's the last thing of the conversation, is if you notice how the spikes are happening. See, if you look at MA2 versus MA10, you're noticing this difference, right? And you're looking into a daily chart, you'll notice that if you keep this tolerance percentage, which I explained, very high, you're looking into something which is heading north for sure. So that's why I'm saying that when you find a sweet spot, and you find a sweet spot like this, you can settle a stock within few minutes with this large percentage gain. So if you take an example here, let me pick up another example. These are okay. Let me take something which is heading north here, which is say CL. These are examples, but I'm just trying to see if I can get some examples here, which is Colgate and Palmolive. So now if you take a look at this, now if you take a look at the S&P is increasing, you want the purple line to go higher than the green line, right? Under that circumstance, you would like to trade, so you can wait. You are seeing that you're telling the algorithm that, okay, don't trade under this circumstance because the trading time is still not there. But once it comes, you grab it. Say, for example, if you go back a little bit, and here if you're looking at, see, if you're looking at the purple line, which is much higher than the moving average 10, as an example. So when that happened, what happened? You can see the blue line, it took like it kept heading north. So this is exactly the point I'm trying to make. You cannot go wrong if you are following these clear instructions which I have explained, and you had the patience to listen to probably 1.5 hours of my presentation. There's no way you will go wrong. The only scenarios which may happen as an odd is, say, for example, at 10 o'clock you took an investment and by 10:10 the market had a crash. Those are the only odds against you, and that doesn't happen every day, right? It hardly happens that within 10 minutes a market has crashed. It does, but it doesn't happen. So your odds of losing money is very low but your odds of winning money, and if you really look into what I have explained and what I'm demonstrating here in the chart, there's no way things can go wrong because emotions are not playing here at all. So, having said that, I would like to conclude my presentation, but at the same time, if you feel that it is important for you to get in touch with me, of course, you have the WhatsApp connection here on my website, and at the same time, you can get to my calendar. It is very important because I sometimes get very busy with a lot of people, a lot of questions, but get to my calendar. But please, before you get to my calendar, you go through the YouTubes. There'll be one more which I'm talking about on this presentation, which will be here. I don't know how long it might take, but it might be worth listening because at the end of the day, if you get a sweet spot, you're going to me every day for years to come till I serve you. So I don't have to explain the opportunity and the potential of passive income, but you have to go by the rules. In quant trading, everything is mathematical. If you play around with the system, you're playing directly with you're basically juggling and trying to do something which I also cannot answer. So if you are methodical and what I have explained here is very clear and it's you have, of course I'll help you with question and answers if you do, but if it is very clear to you that every action has an equal and opposite reaction and you don't want to play around with it unless you are very sure, please don't do. So having said that, let me conclude this presentation for now, but I will look forward to have a conversation with you going forward. But trust me, with this type of a software product with so much of capabilities inbuilt in it, and there's a lot of other sections which I haven't even touched, but I will just try to explain to you that where you can take a look about on those. Say if you go to individual or if you go to business, say you go to individual and you're looking for intraday is the scope of the discussion which I just mentioned. Just a second. The system is a little slow. I don't know why the internet is a little slow now. Just a second. This is something which doesn't happen, but it is happening now. So maybe the individual, I'll have to relook into that. But say, for example, why, if you're looking into intraday, you'll find lot of features which I haven't even touched, haven't even spoken about. Risk management, cash management, fund management, like this software which you'll be using with quantitative trading techniques is very unique. You'll not find it anywhere, at least as on today's date, I can tell you. If you find, you let me know. But whatever I taught you or whatever I spoke about so far, remember I was talking about PNL where you can set it up to say 0.21% and leave it on its own. So every time when it reaches 0.21%, it'll exit out. So having said all of this, if you look into the scenarios of quant trading, and once you get the configurations right, you run it every day. Every day it'll be the same story. The thing is, you cannot have your mindset with greediness overruling the configurations. In my case, once I configure something and I'm happy, I don't even get back to it. I don't even look at it for years and it's running every day. So having said that, please feel free to get in touch with me and I'll be more than happy to help you. Thank you.